No emergency declaration, no government shutdown, just a quiet, calculated decision by corporate America that those jobs were no longer worth keeping. And that single number, the 1.2 million, is the spark that's setting off a chain reaction most people haven't traced all the way to its end. Here's how it works. When over 1 million workers lose their income, the ripple moves fast. Restaurant tables sit empty. Local shops lose their regulars. And without that steady foot traffic, small businesses start bleeding out. Corporate bankruptcy filings surged to a 15-year high in 2025, with more than 700 companies going under. Small business bankruptcies jumped 30% in the same period. Brands that felt permanent, Red Lobster, Rite Aid, Party City, quietly disappeared from strip malls across the country. But the third domino is where things get truly serious. Every one of those failed businesses was leasing space. Every empty storefront represents a landlord who can no longer collect rent and a lender who can no longer collect a mortgage payment. Right now, there is $1.8 trillion in commercial real estate debt scheduled to mature in 2026. According to current data, more than half of that isn't getting paid back on time. That's not a forecast. That's already in motion. And the fourth domino, it's the one landing on your street. Mortgage delinquencies are climbing. Foreclosures jumped 59% in a single year, and specific housing markets across the country are already absorbing the damage. These four forces aren't separate stories. They're one story. Let's walk through all of it. Start with the jobs, because that's where the entire sequence begins. 2025 was supposed to be the year the economy found its footing. Instead, U.S. companies announced more than 1.2 million layoffs, the highest volume since 2020, when the economy was physically shut down by a global health crisis. This time, there's no crisis forcing anyone's hand. Companies are choosing this. And the pace isn't slowing, it's picking up. The final quarter of 2025 posted the worst quarterly layoff numbers since the 2008 financial crisis. What makes this cycle different from previous downturns is the breadth. It's not one sector contracting. Amazon eliminated 16,000 corporate positions. UPS cut 30,000 jobs on top of the 48,000 already gone. Salesforce, Target, Nike, Home Depot, the Washington Post. The list spans industries and income levels. More than 5,200 companies announced mass layoffs in 2025. And within just the first 50 days of 2026, an additional 40,000 tech workers were let go, roughly 800 people losing their jobs every single day. The driving force behind much of this? Artificial intelligence. A Goldman Sachs analysis of thousands of corporate earnings calls found that nearly half the companies discussing workforce reductions specifically cited AI or automation. Entire departments are being replaced by software at a speed that's outpacing any workforce transition plan. But what the headlines rarely follow up on is what happens next. Because when 1.2 million people stop earning, they stop spending. And that spending collapse is exactly what's showing up in the bankruptcy data. Look at what's happening on Main Street. The names I mentioned, Red Lobster, Rite Aid, Party City, aren't isolated cases. At least 717 companies filed for bankruptcy through November 2025, a 15-year high. Spirit Airlines, Claire's Joann, At Home. These aren't obscure businesses. These are brands that anchored shopping centers and suburban corridors for decades, now gone. Small business bankruptcy filings rose 30% year over year. The Subchapter 5 category, designed specifically for small business reorganization, grew 11%. Through November alone, more than 2,200 small businesses filed, already 8% above the total for all of 2024. The restaurant sector tells you everything about how this stress is playing out at ground level. Wendy's reported an 11.3% same-store sales drop and announced plans to close up to 358 locations in the first half of 2026. Jack in the Box is shutting between 150 and 200 stores. Denny's closed nearly 100 locations. Starbucks shuttered 400. Red Lobster is reviewing additional closures after already closing 130 during its bankruptcy proceedings. The math is brutal. Food costs up 35% over 5 years. Labor costs up 35%. Menu prices up 31%. And customers are still walking out. Now, here's the piece that matters most to real estate. Every single one of those closed restaurants, those dark storefronts, those shuttered chains, they were paying rent. They were occupying commercial space in strip malls, office parks, and retail corridors. When they close, that space goes dark. When space goes dark, landlords lose income. And when landlords lose income, lenders stop receiving payments. That brings us to the $1.8 trillion problem. In 2026, $1.8 trillion in commercial real estate loans are scheduled to mature. According to Morningstar data, more than half of the roughly $100 billion in securitized commercial mortgages coming due this year are unlikely to be paid off at maturity. The payoff rate has collapsed from above 80% in 2023 to under 50% today. Office real estate is at the center of it. Office loan delinquencies in commercial mortgage-backed securities hit a record 12.34% in January 2026, the highest figure ever recorded. National office vacancy is hovering near 20%. 1 in 5 office buildings in America is currently sitting empty. For the past 2 years, the commercial real estate world has operated on what insiders call extend and pretend. Lenders rolling over troubled loans on the assumption that the market would recover before anyone had to take a loss. That strategy has officially run its course. Close to $25 billion in CMBS loans are now past their maturity date with no repayment, no liquidation, and no extension granted. Those are post-2008 cleanup levels. The banking exposure here is significant. Following the regional bank failures of 2023 at Silicon Valley Bank and First Republic, it became clear that smaller and mid-sized institutions carry heavy concentrations of commercial real estate debt. Estimates suggest nearly 280 banks have dangerously elevated commercial real estate loan exposure relative to their capital reserves. In January 2026, Metropolitan Capital Bank and Trust in Chicago became the first bank failure of the year, with 82% of its loan portfolio tied to commercial real estate and private equity. That's not a warning shot. That's the first confirmed casualty. Map the full chain. Workers lose jobs, consumer spending drops, small businesses fail, commercial spaces empty out, landlords default on mortgages, banks absorb the losses. Each link in that chain feeds the next one. And unlike 2008, policymakers today are working with far less room to maneuver. The pandemic stimulus has already been deployed. Interest rates are still elevated. Inflation hasn't fully cleared. The tools that contained the last crisis are largely unavailable for this one. The CEO of JP Morgan Chase recently went on record warning that a recession in 2026 is a realistic possibility. He described the national debt trajectory as unsustainable and characterized the broader environment as fundamentally inflationary, so pointing to government deficits, high asset prices, and lingering pandemic-era financial distortions. When the head of the country's largest bank says that publicly, it's worth paying attention. Now, here's what homeowners specifically need to understand, because the damage isn't staying in commercial real estate. The Mortgage Bankers Association reported that overall mortgage delinquencies climbed to 4.26% in the fourth quarter of 2025. But that headline number understates the pressure building at the lower end of the market. FHA loan delinquencies, covering the mortgages that first-time buyers and lower-income households rely on, reached 11.52% in the same period. That's the highest level since the pandemic peak. FHA loans represent only 15% of the total mortgage market, but account for more than half of all seriously delinquent loans in the country right now. Foreclosure completions jumped 59% year over year in January 2026, the 11th consecutive month of increases. In November alone, 609,000 borrowers became newly delinquent in a single month, the largest single-month surge since May 2020. The geographic impact is already visible in specific markets. Austin home prices are down 6.1% year over year and sitting roughly 20% below their 2022 peak. Tampa has posted 13 straight months of price declines. Washington, D.C. is the clearest case study connecting layoffs directly to housing. Federal workforce reductions pushed housing inventory up more than 50% in a single year. And nearly 40% of local real estate agents reported that prices are actively declining because of those job losses. A recent Federal Reserve Bank of New York study confirmed the pattern. Counties experiencing the sharpest unemployment increases are also seeing the worst spikes in mortgage delinquency. That's not a coincidence. That's the domino chain landing on residential real estate. The one factor keeping this from becoming a full-scale 2008-style collapse in housing is equity. More than 80% of current homeowners have at least 30% equity in their properties. That's the single biggest structural difference between this moment and the last crisis. Most homeowners who run into financial trouble can sell at a gain rather than defaulting, but that cushion has limits, and it doesn't help the families who bought near the peak using FHA financing with 3% down. For that segment of the market, the financial pressure is already real. So where does all of this leave you? If you own commercial property, stress test your portfolio immediately. Look hard at your tenant mix. Which of your renters are operating in distressed industries? What does your cash flow picture look like if 2 or 3 of them close in the next year? Can you still cover your debt service? Run those numbers now, not later. If you're a homeowner, zoom into your specific market rather than following national headlines. Austin, Tampa, Denver, Phoenix, and Washington, D.C. are showing measurable cracks. If you're in one of those areas, pay close attention to active listings, days on market, and price reductions in your neighborhood. If you're holding an adjustable rate or FHA loan, review your payment structure carefully. If you have strong equity and you've been considering selling, understand that the window to sell at peak prices has already started closing in several of these metros. If you're looking to buy, the most disciplined move right now is patience. Distressed properties, both commercial and residential, are going to surface in greater volume as these maturing loans force decisions that lenders have been avoiding. Real opportunities will emerge, but they'll reward buyers who are prepared with cash or pre-arranged financing because credit conditions are more likely to tighten than loosen over the coming months. If you're a salaried employee, don't assume your position is protected simply because your company hasn't announced cuts yet. Build your emergency reserves. Look at ways to diversify your income. The companies that trimmed aggressively in 2025 aren't done, and those that held back are watching the ones that cut first and in calculating. If you run a small business, scrutinize your margins with fresh eyes. The businesses that are navigating this environment are the ones that already made the hard decisions, tightened their cost structure, diversified revenue, and didn't overextend on their leases. And whatever you do, avoid using your home equity to stabilize a business that's already bleeding. That trade turns a business problem into a housing crisis for your family. Here's the summary. 4 dominoes. Mass layoffs triggering record level bankruptcies hollowing out commercial real estate debt cascading into the banking system, and now all of it seeping into the residential market you live in. These aren't parallel stories running alongside each other. They're one reinforcing loop where each failure makes the next one more likely. The data points are there in plain sight. 1.2 million layoffs, 717 corporate bankruptcies, small business filings up 30%, $1.8 trillion in commercial real estate debt maturing, office delinquencies at an all-time high, FHA mortgage delinquencies at 11.52%, foreclosures up 59%, price drops already documented in Austin, Tampa, and DC. And yet, the dominant economic narrative still describes this as a soft landing. The data doesn't support that conclusion. What it supports is the idea that the feedback loop is already running, and the people best positioned to protect themselves are the ones paying attention now, not after the next headline forces them to. At US Realty Pulse, this is the kind of data we track every week. Because in a market moving this fast, being a week behind isn't just inconvenient, it's expensive. If this breakdown helped you see the full picture more clearly, subscribe and turn on notifications. The viewers who get this information first have more time to act on it. We'll have the next update ready when the numbers move again.